Okay, so good morning, everybody. Thanks for being here. Now, well, I guess these Dean seminars are usually, a chance for new faculty members to introduce themselves and to present their work to the rest of the SBS community. I am not brand new because I joined last August, so it's already more than 1 year. But I guess this is, anyway, a chance for me to thank you for your warm welcome during this 1 year and a few months. And the way I want to thank you is by not presenting my most theoretical, hardcore asset pricing work, but instead I decided to focus on something more empirical. This is a very recent empirical work I have, and here I have a disclaimer, because one of the things I'm learning here is not to overestimate the time available for research when you're teaching 2 sections of MBAs. So this is very preliminary, okay? But anyway, I thought it was interesting to tell you about the idea and tell you about my preliminary results. So this is a joint work with Andrea Boraski at Imperial College and Paul Whelan at Copenhagen Business School. And in a few words, what we want to do is to study expectations about bond returns taken out from survey data. And we want to compare these expectations with bond risk premia taken out from statistical models. So if you want the standard way of computing expected bond returns in the literature. And probably our final goal is to say something about the way in which agents form their expectations in fixed income markets. And since I guess most of you are not familiar with some of these topics, I thought I had to start defining some of the key objects in fixed income markets. And I also have to convince you that studying bond risk premia actually matter. So first of all, what is a term structure? I have this term in the title. I'm not sure all of you know what I'm talking about. Well, term structure is simply a graphical representation of interest rates of zero coupon bonds, which are basically benchmark fixed income instruments, as a function of their maturity. Okay? So loosely speaking, this is the interest rate that you can get investing now at a 1-month horizon, 3 months, 6 months, 1 year, 2 years, and so on. Okay? And the shape of this object is usually upward sloping. Okay? Now, the short end of the term structure is more or less governed by the behavior of the central bank, by the monetary policy. Now, what does the rest of the term structure tell us? Well, it should reflect expectations of market participants about the future behavior of interest rates. Okay? Now, I just said that usually the term structure is upward sloping, even if, you see here, it can move over time, so take different shapes. But the fact that the term structure is upward sloping, what does it mean? Does it mean that now it's more convenient to buy, let's say, a long-term bond relative to a short-term bond? Well, based on the conventional wisdom until a few decades ago, the answer was no. The upward sloping term structure of interest rates basically reflected expectations of higher short-term rates in the future. Okay? So basically, if this holds, if you invest in a long-term bond or just roll over short-term bonds over time, if you have the same investment horizon, you're going to get the same expected return, or the same realized return, actually. And this is the so-called expectation hypothesis. But the literature since then has successfully proven that this expectation hypothesis doesn't hold. Okay? So it seems to be the case that indeed an upward sloping term structure of interest rates means that investing in a long-term bond gives you more than investing in a short-term bond. Okay? And this basically means that looking at the shape of the term structure, and in particular the slope of the term structure, we can predict future excess returns. Now, I want to make things clear from the beginning. Predictable bond returns is the same thing as saying that expected bond returns vary over time. Okay? So we say that the slope of the term structure predicts future excess returns on long-term bonds. This is equivalent to saying that expected bond excess returns vary over time. Okay? So if we can show that expected bond returns vary over time, we are basically rejecting the expectation hypothesis. Well, the fact that there is this predictability in bond markets is a challenge for the monetary policy, because monetary policy usually controls, as I said, the short end of the term structure. Okay? And well, since these first few papers, there has been a whole literature trying to understand what are the drivers of expected bond returns. And well, a number of papers have shown that different variables can actually explain future excess returns, such as, well, as I said, the slope of the term structure, or the level of the interest rates, macroeconomic factors, liquidity, variance risk premia, you name it. Okay? You can find a number of potential variables which explain or are shown to explain future excess returns. Well, if this is the case, so if excess returns on bonds are predictable, why did investors try to exploit this information, okay, and make a lot of money? Well, there are two potential explanations for that. On one side, well, we could say that maybe they thought that these trades were risky, or their risk aversion was higher. On the other side, so another potential explanation is that ex ante, their forecast about excess returns were not equal to what we measure now, ex post, okay, using realized returns. So this explanation is based on beliefs. Well, usually, most of the literature in fixed income markets focuses on the first channel, the risk assessment, okay? Even if recently there have been a few papers trying to, look at the relative importance of risk assessment and beliefs in different markets, actually. So what we do is to try to focus on beliefs. If we do that, well, the natural question is, how do you measure expected bond returns? Okay? And as I said, the standard way to measure expected bond returns is to just run a regression. So project future realized returns on a series of variables observable at time t. But, well, another literature, more statistical literature, has shown that these projections, these regressions, have a number of statistical problems. On one end, we don't have enough data, so there could be small sample biases. Then even if you take into account the small sample bias, it could be that overfitting or model misspecification may mislead your economic understanding of the data. And finally, these models, these statistical models to derive expected bond returns, rely on very strong assumptions, usually. Okay? So overall, well, the key observation is that these models may tell you very different things about expected bond returns. So depending on the model you choose, yeah, Richard.
Yeah, so there's two things confusing me so far, and there's going to be lots more, I'm sure. But so the first one is, don't you know the expected bond return? You know the price, and the characteristics of a bond is its contractual cash flow, so you know the cash flow, right?
Well,
so can't you just work it out?
So you think that this is partially true. So if you buy a bond now, and you keep it until maturity, you know exactly what you're going to get. Yeah. That's what you're saying, right? So you get the coupons, and you get the principal at the end.
Yeah.
Right. But when is a bond risky? Well, if you buy the bond now, let's say a 5-year bond, and you sell it in 1 year. So if your investment horizon is 1 year, you will need to sell the bond in 1 year. the price of this 5-year bond in 1 year will depend on the behavior of the interest rates. Okay? Because the current price is always
But ultimately, it's only going to pay out the cash flows. So why do transactions?
Yeah, but the present values of this cash flow changes over time, together with the interest rates. So, well, this is what I'm explaining to my MBA students, so I should be good at it. But so, if you want to compute the price now of, let's say, a 2-year bond, okay, pays a cash flow, a coupon of $5 every 6 months, okay? The price today is the discounted value of future coupons and the principal, okay? How do you compute the present value? You have to take these future cash flows and discount them using the interest rates for that particular maturity, okay? So if interest rates change, the value of the bond might change over time, okay? Now, obviously, if you're just thinking about the cash flow and you keep the bond until maturity, that doesn't matter too much, okay? Because anyway, you know what you're going to get. We're talking about risk-free bonds, so there's no default risk here. But anyway, so the behavior of interest rates may change, the value of these bonds over time. Okay? So there is still some risk. You don't know what is the price of a 5-year bond in 1 year. That's what I'm saying. Okay? So you don't know what is the realized returns. And well, you can make expectations. You can form expectations about what's going to be the price of this 5-year bond in 1 year, okay? And this expectation will depend on your expectation about the yield in 1 year. You see what I mean? So this was one doubt. You said you had 2 doubts.
You carry on, because I don't hold everybody up.
Okay.
That's fine.
Can I just?
Yeah, sure.
I thought you were going to answer, your answer was going to be there's inflation risk.
There
Can you
is
say something about nominal versus real?
also, yeah, so the interest rates I'm looking at are nominal. So yeah, there is also a component related to inflation expectations, yeah. But even if you don't look at inflation expectations, I mean, well, the fact that interest rates change over time is related to inflation expectation, is related to, opportunity costs and so on and so forth. But anyway, the fact that these interest rates change.
What you're trying to do is
measure expected
nominal
bond
or
returns.
real returns?
Nominal.
Uniform.
Nominal. Nominal because the survey data I have are for nominal interest rates. Then I also have inflation expectations. So I could derive a real interest rate forecast, but we don't do that. Yeah?
Just to clarify, so the heterogeneity is heterogeneity in beliefs about interest rates, basically.
Yes.
That's what you're looking at.
Yes.
Okay.
And this translates into heterogeneity in beliefs about bond returns and excess bond returns. Okay? So, well, as I said, standard way to measure expected bond returns, you take realized excess returns, you regress these realized excess returns on, well, a series of variables observable at time t. Okay? There are a number of statistical problems in doing that, and mainly, I mean, if you choose different models, they will give you a completely different picture of the dynamics of expected returns. Okay? Plus, even if we agree on a model, if you use a different benchmark period to estimate this regression, you may get a different value for the expected return. Okay? So what do? Well, we use direct measures of expectations taken from survey data. Okay? And, well, I would say that the use of survey data in not only the fixed income literature, but in general in asset pricing, is picking up recently. On one hand, because, well, these databases are, well, much better than what they used to be some time ago. And so people are starting to believe, actually, in these survey forecasts. And these forecasts have a number of advantages with respect to the statistical measures of risk premium I talked about. First of all, they are really forward-looking. So when you measure the expectation, is the expectation now for a future period. So it's not, using ex post data. And we don't have to make any assumptions about the model, okay, or about the behavior of the expectations themselves, and so on and so forth. And in addition to this, we can also exploit the cross-section of expectations, because, well, in our case, every single month we'll have, on average, 40 professional forecasters telling us something about their expectation of interest rates. So we can exploit this cross-section to improve the inference, for example, when we look at the drivers of expected bond returns. Well, the natural question at this point is, can we trust surveys? And, well, it seems that we can. So, as I said, people have started using this survey forecast, this data in academic literature, and somebody showed that, well, on one end, they seem to perform well. So if you look at macroeconomic series, as here, so they look at forecasts about GDP growth and inflation, and they show that forecasters do actually better than models, statistical models. Chisek and Povala do something similar for federal fund rates. So they also show that forecasters do better than statistical models. And Greenwood and Schleifer show in forecasts for the stock market that they are related to fund flows. Okay? So this is another way to show that actually these forecasters know what they are doing and they take it seriously, in a sense.
Aren't they optimistic on average?
I will talk about optimism and pessimism, and we will see that there is a systematic bias in the forecast. But yeah, I mean, I would say that it depends which forecast you look at. Okay? In general, we can say that forecasts do relatively well for macro series, so for GDP growth, inflation, for Fed fund rate, and they seem to be related to fund flows. So this is a reason to, if you want, believe this survey data. Then I will show that in terms of expected returns, they don't do that well. Okay? And the reason is that, as you suggest, there will be a systematic bias in the forecast. But I will talk more about that.
No.
Yeah.
Will you be saying something about the sampling strategy to identify the people who are
Good and bad.
respondents to the survey?
We know the names of the respondents. So, well,
No, but I mean, is there a particular sampling strategy that you've used to sort of identify in order to have
a better.
the sort of variation that you want, etc., that you've got the sort of brightness of people in the survey?
This is a good point. So usually you just look, well, when you have a cross-section of expectations, a cross-section of forecast about, well, in this case, yield, okay? Usually what people do is just, well, to take the median, the consensus forecast, okay? So a number of papers have just looked at the consensus forecast as a measure of expectation. Okay, what I want to do is to look at all the cross-section, so the individual forecast and the different quartiles or quantiles of the cross-section distribution. Then the question is there a better way to combine these individual forecasts or to combine the quartiles to, I mean, in order
There's
to...
a sort of prior question, which is the strategy, the sampling strategy that is used to include in the survey.
To include in the surveys, no. So, well, we actually don't know exactly how they
So how do you
get into and outside the panel. We just see that they tend to stay in the panel for a relatively long period. So our sample is from 1988 to 2015 on a monthly basis. And over this full sample, we have something like 160 forecasters. They are not in the panel for the whole time period, obviously, okay? But on average, they are in the panel for at least 80 months. Okay? Now, we don't know exactly why they leave or why they get into the panel. We know their names, and we see that sometimes they get back into the panel. So this is an interesting question. We should try to know more looking at the database itself. But I don't think there's any bias related to the fact that they are in the panel or not at a specific point in time.
It's just in other panel data, people go through very elaborate lengths to make sure you're sort of subsampling in a way that doesn't bias the results you find.
Yeah, no, in general, this dataset is already quite clean, and so you can use it without too many problems in terms of who participates into the panel and so on and so forth. Also because, as we said, we know the institutions, we know the names. These are leading financial institutions and leading analysts inside these financial institutions providing forecasts. So there is also a reputational constraint. I would say.
Building on that point, is there any way you can simply check whether there's selection bias or not by comparing the forecasters in your survey with the general population forecast to see whether there's any difference in the
yeah, we compared this sample with other survey data like the survey of professional forecasters or other samples, but this is much richer. What we use is much larger. So, for example, the survey of professional forecaster is just available on a quarterly frequency. Our data is available on a monthly frequency. And they usually have a smaller cross-section as well. So this is probably the most representative in the sense that this is the largest sample. Then obviously, I can't tell you anything about those analysts who are not making any forecast, or at least not publicly available. But I think this is quite representative. Okay? And we have reasons to believe that actually they are also the representative investors in the sense that they affect prices. Okay. Right? So at the end, what do we do with this data? What do we do with these subjective measures of yield expectations? Well, first of all, we analyze the data. And this is already quite interesting by itself because, as I said, it's a very unique database. It's very rich. At every point in time, every month, you have a whole cross-section of forecasts about the whole term structure of interest rates at different horizons. Okay? So there's already a lot to say in this respect. But then what we are mostly interested in is to, as I said, to compare these subjective expectations of bond returns with the expectations taken out from statistical measures. Okay? So for example, we want to understand which models do forecasters have in mind when they form their expectation, or how many factors do they take into account, and so on and so forth. Okay? And so we also look at, as I said, this relation between models, and we find, well, I'll tell you later, but basically, there's a lot to say about this relation between statistical models and survey forecast. And it's interesting to look at the predictive power of these forecasters as well. Okay? So we said that forecasters tend to be, well, relatively good at forecasting macro series. Are they equally good at forecasting bond returns? And we want to see whether there is a systematic bias in the forecast as well. And that's why we look at the dynamics of the forecast errors. And then we want to provide a theoretical explanation for these dynamics of the forecast error. And then the sixth point is still a work in progress. This is not included in the paper yet. But the final goal will be to think of a general equilibrium explanation for this whole cross-section, so the dynamics of this cross-section of forecast, and try to include these in a term structure model.
No,
Yeah.
You said you know their names?
Yes.
So there is a paper by Anna Tinak, I'm sure, which argues that there's one particular forecaster who has inside access to the Fed.
Yeah.
And they've been trying to get his info on newsletters for 20 years. They've not succeeded. And you've got a forecast.
Well, I don't know if I have his forecast, but probably, yeah. Yeah.
You can see if he's unusually good.
That's true. Well, I know who is good. We can talk about it. I don't like name dropping, so you will not see too many names in the presentation. But yeah, you'll see it in the paper. Yeah, Oram.
Just worth saying that in the last 10 years, the central banks were so bad in predicting their own monetary policy that access to their own information will not be such an asset.
Yeah, actually, you also have forecast. You also have forecast from people working at central banks. So this is called the green.
The comparison of what the central banks said that they will do to what they've actually done.
Yeah, but also what they thought they would have done and what they've done. Yeah.
What is your forecast sorry, the forecaster's horizon. The
Yeah.
overlapping horizons, you have the issue of serial correlation, quantity.
Yeah, so, well, our data are available at different horizons. So they, at each point in time, they make forecasts about yields for the current quarter up to 5 quarters ahead. We construct measures of forecasts at a fixed 1-year horizon, and we focus on a 1-year horizon in this
So
analysis.
they're overlapping.
They are overlapping, yeah.
Do you deal with the serial correlation?
Yeah, I mean, you'll see more or less how we do it. But basically, this doesn't affect it's not. But there is a lot of persistence, I will show you, in the data and in these expectations. But this is not a problem for the things we would like to say. And well, if
We'll talk about it in a minute.
yeah, and if you have problems, just yeah.
One quick question. You emphasize sort of the difference between forecasters and models.
Yeah.
I thought the models were about the forecasters.
No.
Like what's
By
the,
models, I mean this, econometric way of deriving expectations by running regressions or projections
right.
of future realized returns on the information at time t. Okay.
So these models don't say anything about the forecasters.
No,
They're not interested
no,
in heterogeneity and expectations. Okay.
Yeah, no, exactly. They just take the expectation as given. Okay.
Right.
So you run this regression, you take the estimation of the regression, and this
Yeah.
is your expectation of bond returns. Okay. Yeah.
Because at the beginning you said that these surveys and these forecasters in the recent literature seem to be doing better than the modeling efforts. Given that
For
you've got-
macro forecasts, so for GDP growth, for inflation forecasts, for Fed fund rate, you see that they're not particularly good
I see.
with
Because given that
returns.
you've got perhaps the biggest survey of forecasters, you may also, as part of the subset of the paper, also look at the
Yeah,
comparing
yeah,
what
yeah.
models would predict.
Yeah, definitely. Yeah, those are good. Okay. So, well, why does it matter? I think now I more or less convinced you that it's kind of interesting to look at bond risk premia, and yeah, sure.
So the cash flows are fixed. Right?
Yes,
What's changing is the value of the cash flows,
yes,
which is a function of what forecasters think interest rates will be.
yeah,
So forecasters are determining price changes. So what you're really testing is the difference between the quality of the survey, right? Because forecasters do drive prices, and what you've got is a survey of what they say about it. Is that right? You see what I mean? So it's not, you're not
yes,
comparing
it's
forecasters with
partially
models,
about,
actually.
it's also about the quality of the survey. So it's also about how
But
good
isn't
they
it
are.
just about the quality of the survey? If you had a perfect survey of forecaster opinion, you would have an explanation.
I mean, if the prices are driven only by their expectation, right? But then, so this relates to what I wanted to tell you at the end. So to what I think you were also mentioning before. So how do you combine the forecast,
Yeah.
right? So if you just take the consensus forecaster, so the median, is he the representative investor, the agent driving prices? Probably not. There must be, a better way to take into account the different individuals, maybe also considering their past performance. And this is related also to general equilibrium models with disagreement, because usually the representative agent would be a weighted average of the individuals, okay, considering their wealth in the economy.
So if you take Mungo's theory, you put a heavy weight on one forecaster in your survey, and you adjust the survey, and you get a better, you get a adjusted survey that explains prices.
Yeah. Theoretically you could. So you could think of an optimal weight to give to the individual forecaster, so let's say to the quartile of the distributions, in order to, in one sense, maximize their predictive power, or in your words, to make sure that they are representative of, the price change. So yeah, this is what we would like to do as well. Okay, and this is important also for term structural models, because recently some models have tried to use survey data to, estimate standard term structural models. But, well, if you think about it, if the model itself is not, or the dynamics of expectations implied by the model is not consistent with the empirical dynamics of these expectations, then, there's something weird. So maybe we have to come up with a new class of term structural models which is consistent with the empirical dynamics of expectations that we estimate. Okay? And here are our main findings. Well, so far, as I said, it's very preliminary. But we find that there is a lot of heterogeneity in individual risk premia. And just looking at the consensus, as I mentioned before, is not really the best way to take into account all the information available in the cross-section. And forecasters seems to be persistently optimistic or pessimistic about expected excess return. So basically, there's a large probability for a forecaster being in, let's say, the first quartile of distribution, he will still be in that same quantile of the distribution the following month. Okay? So the optimistic agent tends to stay optimistic, the pessimistic agent tends to stay pessimistic. We'll talk more about this. And this is related to other papers which show a similar behavior for macro forecast. And we show that, well, on one hand, these expected bond returns are indeed time varying, as argued by this previous statistical literature taking out expected bond returns. And there seem to be very related or largely driven by the information contained in the current term structure. Okay? But this is not true for all the agents. So as I said, there's a lot of heterogeneity. So different agents may take into account different models or weigh differently the information included in their information sets.
Do you have the actual survey items or regressions that you use to sort of come up with findings, or sort of on you? I'm just curious.
If I have the regressions which I use to come up with the findings?
Well, just the survey, the questions that you were asking.
The question.
Yeah,
They provide numbers, not questions.
Ah.
So every month, they tell you what they expect the interest rate at 1 month, 3 months, 1 year, 2 years to be in 1 quarter, 2 quarters, 3 quarters, 5 quarters, 5 quarters. So it's not qualitatively, it's purely quantitatively.
Okay, I see. And that was the only question they were asked, is what do you expect?
Yeah, they forecast interest rates, they forecast GDP growth, inflation, a number of other things. Then sometimes they're also asked about their general outlook of the economy, so something more on the qualitative side.
Was it like at the level of an institutional investor, how the company as a whole sees interest rates for the next quarter, or was it individual investment?
Well, it's an individual analyst who provides the forecast, but it should be representative of the behavior of the financial institution itself.
Right. So did you aggregate across institute? So if we have some people
we look at the
institution.
individual. No, we just have one person for each institution. So we see the name of the institution first, and then if you want, you also look the name. You can see the name of the analyst. Thomas.
I think the two things. One, I think it's just a confusion. You didn't gather this data, did you? Is it you gathered it, or is it a reputable market?
It's
Not that you're not a reputable market.
it's from Blue Chip Financial Forecast.
Okay, so it's not you.
It's not me, yeah. It's done by them, and they provide us with PDF files of all these forecasts every month, and then it's our job to convert this into this.
And then the second question, it's sort of a little bit paranoid, but
Yeah.
we've just been through a LIBOR scandal
Yeah.
where clearly people are not reporting truthfully because they're trying to manipulate something. Is this a potential issue here?
So as I said, we tend to believe that they really mean what they say. So, well, this is as usual a very crucial issue when you look at survey forecasts. We believe that they actually, know what they're doing and they tell you the truth. And again, there are different reasons to believe that this is indeed the case. And one way to check this is to look at the relation between the forecasts and fund flows. Okay, so to try to get the intuition whether they trade based on their forecast or not. And again, you can also look at how they, the predictive power basically for future realized returns. As I said, for bond returns, they don't do very well. So there is a bias, definitely. Then you can try to come up with explanations for this bias. And I'll try to say something about these towards the end. It could be also for reputational purposes. So in some cases, they don't want to, say something which is too far from what they said the previous month, for example. Okay?
Well, I think there's a potential analysis to see whether the institution that has a deep role in the market will have a different bias pattern than an institution that's maybe not so much in the bond market because they're getting more.
Yeah, I mean, you don't know much about their trades, right? The problem is that you cannot relate directly one institution, so one forecast, with what they actually do in the bond markets, okay? Because you don't have their position. It would be nice, obviously, to try to relate their expected returns with the positions they take. It's not possible to do that. So the only thing we can do is to look at the aggregate positions in the market, so fund flows basically. But yeah, if you have any idea how to check the position of the individual institutions, let me know. Yeah.
Is there any way you can use a survey data with robustness testing to cross-correlate responses to general outlook on the economy versus interest rates versus
We do
other
it.
things that,
Yeah.
okay.
Yeah, that's a good point. Okay, so I already said this a few times. They don't do particularly well. Okay, so their predictive power, if you just look at R squares, is, well, for the consensus, between 2 and 5%, which is lower than what would be predicted by statistical models. But if you look at individual forecasters, some of them actually do quite well with R square even, around 40%. And interestingly, their performance seems to be related to their position in the cross-section. So in general, optimistic agents, in terms of expected bond returns, tend to do better. So if you just take let's say the third quartile of the cross-section distribution, instead of taking the median, the root mean square errors already decrease drastically. Okay? And we would like to, come up with an explanation for this bias. Okay? This is basically due to downward bias in subjective expected bond returns. So we look at the dynamics of the forecast errors and we try to come up with rational explanations for this systematic bias in the forecast errors. And you'll see there are a couple of potential rational explanations of this behavior, even if, usually when you look at forecast errors and you see that they are predictable or state dependent, this is usually evidence of non-rational expectation formation, okay? But there are actually a few potential fully rational and full information explanation of these dynamics of the forecast errors, and I will get to that. Okay, well, I already talked about the data, so it comes from blue chip financial forecast at a monthly frequency. We focus on a 1-year horizon, and the data set is from January 1988 to July 2015. And, well, this is a little bit of notation. Don't worry about this if you don't want to look too closely. But the only thing I want to keep in mind is that I'm going to use this ERX as a notation for the expected bond risk premium, or the expected excess bond return, which is basically the expectation taken under the belief of agent I of the realized excess return at time t+1, always related to a particular bond maturity, which is n in my notation. And I can build these direct measures of expected excess bond returns from my yield forecast, from my panel of yield forecast directly, for bond maturities, so n, between 2 and 10 years. And how do they look like? Well, here is a graphical representation of the cross-section of forecast about excess bond returns for a 5-year bond, okay? Always at a 1-year horizon. And, well, what can we see here? Well, first of all, expectations are time varying. There are also, formal ways to test this. And there is a lot of heterogeneity as well. And the spread, so the heterogeneity changes over time. What you have here are different quartiles of the distribution. So the bottom line is the minimum expected bond return in the cross-section. Then you have the first quartile, the median, the third quartile, and the maximum. And what we find is that the unconditional properties of the different quartiles are quite similar, but the conditional properties change over time. So in some sense, we really see from this data that it's important to look at the whole cross-section of forecast. Okay? It's not enough to just look at the consensus, because you may get misleading interpretations for the relation between bond return and realized returns. Another interesting question is the extent to which individual forecasters are regularly in one particular quantile of the distribution. Okay, so are they consistently or persistently optimistic or pessimistic about bond returns? Well, it seems to be the case. I mean, here in this graph, you just see the average percentile of 4 forecasters, average in time series, so considering all the periods. And this is already a first evidence of persistence in the forecast, but to study this more formally, what we do is to rank every month the forecasters based on the quartile of the distribution in which they are. We do it for every month, and then compute transition probabilities. Now, if there is no persistence at all the numbers in this table should be close to 25%. Okay? While if there is persistence, then we expect the diagonal elements to be larger than 25%, and this is exactly what we find. And in particular, for the extreme quantiles, so Q1 and Q4, you see that the probability for a forecaster being in Q1, in the first quartile, at time t, okay, his probability to stay in the first quartile at time t plus 1 is almost 3 times what it should be under the hypothesis of no persistence. Okay? And as I mentioned, this is consistent with the persistence of macro forecast, which have been shown in the for macroeconomic forecast. Okay, so Patton and Timmerman have an interesting paper where they show that forecasters about GDP growth and inflation are persistently optimistic and pessimistic. We show something similar for expected bond returns. Then it's interesting to look at the link, as you suggested, between forecast about excess bond returns and forecast about the macroeconomy. We have both. Well, so we run a similar exercise. What you have here is the probability for a forecaster being in the first quartile, let's say, of the GDP growth forecast distribution or the CPI growth forecast distribution to be also in the first quartile of the excess bond return distribution or the second, third, or fourth quintile. So if you want, these are conditional probabilities, okay? And what we see here is that there's not much relation between forecast about the macroeconomy and forecast about interest rates or excess returns, okay? But there is an interesting pattern at the extreme of these tables, okay, at the corners, and in particular for CPI forecast. So actually, a forecaster in the fourth quartile of the CPI growth distribution, so the optimistic, the macro optimist, tends to be in the, well, lowest quartile of the excess bond return distribution. And this is consistent with the fact that, we expect good states of the economy to be related with increasing yields and therefore decreasing excess returns. Okay? So this kind of makes sense, but you see that the numbers are not very impressive. Okay? And this suggests that in general, the drivers of beliefs about the yield curve and beliefs about the macroeconomy are largely different.
What are the prediction markets for GDP and CPI?
Sorry?
So there are these markets that are set up. So that specifically, or that was speculate about things like GDP and CPI. Do those exist? And can you compare these forecasters to those?
I don't know. I should check.
I'd like to talk to you about this because there's places like Intrade and others, and people like Justin Wolfers have done a lot of work on this.
Mm-hmm.
And so it's essentially trying to tell you about the expert forecasters, which is people with an interest in it, and gathering the wisdom of the grounds of these prediction markets to get a sense for next quarter, the growth for inflation, all the results from the FOMC or the Fed's decisions. So people bet on these. regressions, these tend to be pretty powerful. I have no clue how predictive these are for economic indicators. And it could be interesting to get that as yet another measure of
or comparison. Good, thank you. Yeah, sure. Okay, so, well, this is a byproduct, if you want. This is not particularly related to expected bond returns, but we can also look at the relation between being in a particular quartile of the GDP forecast and inflation forecast, okay? And it seems that there's not much relation here, so agents do not believe in versions of the Phillips score, okay, at least not. Yeah.
I wonder if you care about, so you anchor a lot on optimism and pessimism, but I wonder about just correctness. And so if you're making forecasts sort of going in the future, one quarter you might be sort of, things are going to be on the up, next quarter you think it'll be down. And so are you more interested in sort of fixed effects correctness related to, say, a specific institutional actor and looking how that persists over time? Does that relate to this?
Yeah, because then we also look at the dynamics of the forecast errors. But what I'm saying is that the optimistic agents tend to make smaller errors as well. Okay? Because
optimism here means that
optimism in terms of excess return. So if you want the macro pessimists, okay? So those who think that the interest rates are going down. Yeah.
Right.
Maybe it's related to the sample we are using as well, because in this particular sample there are more bad times and good times.
Right.
Okay, well, I'll see how this affects the forecast errors. Okay, so what are the drivers of forecast errors? Well, first of all, if we talk about drivers, we have to believe that risk premia vary over time, okay? And we can test it formally. And then a large literature suggests that expected bond returns should be related to the shape of the forward curve, okay? Or the current interest rates. So what we do is to run something like, Family regressions or Cohen-Piazzesi regressions. These are the most well-known papers in this literature. So they show a relation between expected excess returns and the forward spread, or a combination of forward rates. We do the same using our direct measure of expectations, and we show that actually a large part of these expected excess bond returns, or subjective risk premium if you want, is actually related to the shape of the current term structure, and in particular the shape of the forward curve. So up to 50% for the 2-year bond of subjective risk premia, at least if you look at the consensus, is driven by a combination of forward rates. And we can do the same also for, the shape of the current term structure without looking at forward rates. You can take the level of the term structure. Here is proxied by the 1-year rate. You can take the slope of the term structure. The conventional wisdom is that a higher slope in the term structure predicts higher future bond returns, okay, for long-term bonds. Also looking at the relation between our expected returns and the level and slope of the term structure, there seems to be a positive and significant relation. And again, this information related to the current term structure explains a relatively large fraction of our subjective bond risk premium. Then the percentage, the R square, decreases with the bond maturity. Yeah?
When you take what you call the representative, shouldn't you take into consideration the asymmetry around whatever point?
Yeah, I mean,
because if on one side there's much more, if the optimists are much more optimists and the pessimists are pessimists, they will be much more aggressive in investing and have a bigger effect on the market, right?
Yeah, this is true. So I look at regressions for the consensus, which is the median, okay? Just because this is what people do usually. But I agree with you. What we also do is to look at these same regressions for the individual forecasters, okay? And then, I mean, obviously, it would be interesting to try to find a better way to combine these individual forecasts, okay, to take into account the actual effect that they have on prices. I mean, the symmetry is not too much of a problem, because the distribution of forecasts is not too far from symmetric.
There were periods in your picture where the pessimists were much more pessimistic than the optimists were optimists.
Now, I can show you the dynamics of the skewness of the distribution, and it's, well, it can be positive or negative, but it's not very significantly different from zero usually. But we can talk about it. But anyway, I agree with you that some of the individual forecasters may affect more prices, not really because they are too optimistic or too pessimistic, or because there is an asymmetry between optimism and pessimism, but more because you can expect that those agents who accumulated more wealth in the past, so made less mistakes, should have a larger impact. And this again is related to this, general equilibrium models with disagreement I have in mind.
Sure, but that is something that is hard to see here. But
it's sort of, well, yeah, it's...
The intensity of the beliefs is something that you see in your sample.
Yeah, but just looking at that, you cannot build a better measure of consensus forecast, just looking at how they are pessimistic or optimistic. Because again, the distribution is not too far from symmetric. But this is very interesting. I mean, this is something we would like to do. We want to build better measures of, summary measures of the whole cross-section of individual forecasts. And as I said, we do all these regressions both for the consensus and for individual forecasts. And again, we find a lot of heterogeneity in the results. Okay? And this is important because, for example, just looking at the consensus forecast may tell you something wrong about, for example, the effect of a change in the monetary policy, so a change in the short-term rate. Okay? You would like to know what is the effect of this change on expectation of agents in the economy. Well, actually, taking the median effect of the different individual agents or the consensus, so the median agents effect is not the same thing. Okay? Yeah.
Just quickly, I don't know if you have data on this, but you're assuming the forecasts are independent. I'm guessing that if a large player thinks something,
you can also
lots
test.
Of resources that cascades across some kind of social structure where it.
Exactly. One thing you could do is to try to test whether they tend to depend on the consensus forecast in the previous period.
Right.
This has also been done. Okay. So you can check whether they tend to stay close to the consensus. This doesn't seem to be the case because, as I said, there is persistent optimism and persistent pessimism. Okay.
Right.
But still, there could be some, forecast smoothing considerations as well.
Yeah.
I'll talk more about this.
I guess I'm more talking
time,
about heterogeneity, not just in forecast, but heterogeneity in who thinks what, right? So there's some players, Bill Gates thinks
so
something
not the
that matters
consensus,
to
but
some people,
one
right?
particular investor.
Exactly.
Yeah.
But that's all.
Yeah, can't do much. And actually, most of these are leading institutions, so it's difficult to say who should be the leader. But yeah, of course, there's so much to do with state. Yeah. Yeah.
I mean, there are times when the term structure changes kind of in a business as usual way. There's other times it changes in a dramatic way, like it inverts.
Yeah.
So are people, do they tend to be better forecasters in business as usual when they miss the big changes? Or?
Yeah, they tend to miss the big changes, but in particular, when the interest rates decrease. Okay? So if interest rates decrease, they make larger mistakes. They make small mistakes or smaller mistakes when the interest rates are increasing. Okay? But interestingly, they make large positive mistakes also when the interest rate is more or less stable. Okay? And this could be related to, so one of the explanations, well, theoretical, rational explanation for that would be to think about some kind of loss aversion. So maybe they are more afraid of making, negative mistakes than positive mistakes, and this could explain this positive bias in the expected excess returns. Okay, this is already what I discussed: relation between risk premia taken out from forecast and models. As I said, they tend to rely, on a large part, their forecast on the shape of the term structure, but not only. Again, there's a lot of heterogeneity, so I don't want to spend too much time on this. There's quite a lot of correlation between these two sets of measures. But what I want to talk about is how good they are. Okay, So I'm continuously talking about forecast errors and systematic bias and so on. Let me show you something in this respect. So the first thing to do is to just run a regression of realized returns on expected bond returns, okay? And you can do it for the individual forecasters, you can do it for the consensus, you can do it for the different quartiles of the distribution. It seems that the slope coefficient is systematically lower than 1. So if forecasts are fully efficient, the slope coefficient should be 1, the intercept should be 0. The intercept is always significantly positive, at least for the consensus. So this is related to the systematic, positive error they do. Actually, surveys tend to under-predict bond excess returns in most of the times. And so when you take into account all the sample, you find the systematic bias.
The sample starts in 88.
88, yeah.
This is all the great moderation.
The initial period, yes.
There is
and
a
then,
paper by Joe Clark and JFE which says that it's a model of learning. It says, imagine in 1981, nobody realized inflation would just come down and down and down and down forever. We would expect to see exactly this.
Yeah, so that's why I said that there are rational explanations for this positive forecast error. Yeah, and this is one potential story. So all the stories we have in mind again is, one side the heterogeneity in loss aversion. This is one potential story, or forecast smoothing. This is also consistent with our results. Or learning, or, there are also a number of non-rational explanations as well. It could be possible. And it's interesting to try to test at least some of these theoretical explanations, and this is work to do. Again, if you look at individuals, some of them are actually quite good. And, we can discuss the names later if you want. I don't want to do it here. But in general, there seems to be this bias towards optimistic forecast. So optimism, just looking at the third quartile of the distribution, these are root mean square errors. Optimists tend to do better than the consensus. Okay? They still do, worse than most statistical models. But if you consider out-of-sample forecast, only the CP model, only the Cochrane-Piazzesi model does better than the third quartile of the distribution. And this is related to, again, this systematic bias in the forecast error. So just looking at so this is true also on a rolling basis. So if you look at the root mean square errors on rolling windows of 10 years, you see that, probably you don't see the numbers here, but the light blue line is the 90% percentile of the cross-sectional distribution. The black line is the third quartile, so the 75% percentile. Then there is the consensus, the first quantile, and the 10%. So there is a clear ranking here, okay? So all the times, or almost all the times, the pessimistic do worse, and the optimistic, now sometimes the 90% percentile, sometimes the 75 percentile, but anyway, the optimistic agent tends to do better. You also see here a lot of cyclicality in the forecast errors. So in bad times, like beginning of the 2000s, so the burst of the dot-com bubble, and the recent financial crisis, the root mean square errors increase, okay, in general. Yeah?
I know this is encouraging speculation. I mean, but if you imagine the survey sampling from a different period with different sort of macroeconomic behavior, would your intuition be that you would still see this, the optimists doing better than the pessimists? Or
yeah, actually.
So how much do you think it's contingent on a particular period you're sampling?
Yeah, so these are the forecast errors. Now, if you look at these forecast errors, it's clear that they do larger mistakes in bad times, like, the recent financial crisis, forecast errors are consistently positive. Beginning of 2000, again, forecast errors are persistently positive. Now, the question is, are there periods in which the errors are persistently negative? Well, there are some of these periods, like, 88, 93, or 99, but the persistent negative errors in good times are much smaller in absolute value and less persistent. So you see that the phases in which the errors are positive tend to last for longer in general. So independently of the state of the economy, there is this systematic bias. So looking at the whole sample, you see that this is the distribution of average forecast error, looking at all individual forecasters. You see that this is largely skewed towards positive forecast errors. Okay. Now, obviously, the distribution changes with the state of the economy. So the question is, how do you measure the state of the economy, right? There are different ways to do that. It's slightly arbitrary, but one way to look at good and bad states is to look at the behavior of the short-term rate. So you would expect that in good times, interest rates or short-term interest rates are increasing. In bad times, they are decreasing. So what we do is to stratify the sample based on the change in the short-term rate relative to the previous period. And we consider periods of decreasing rates, periods in which change in the short-term rate is at least 10 basis points negative. If it's larger than plus 10 basis points, it's increasing, and we call stable phase in which the change in short-term rate is between minus 10 and plus 10 basis points. Again, this is slightly arbitrary, but if you use different definitions of good and bad times, you will find very similar results. And the interesting thing here is that in decreasing and stable phases, the very optimistic guy, so the 90% percentile, is always the best, okay, for all maturities. So it tends to have the lowest root mean square errors, and even forecast errors, average forecast errors. While in phases of increasing interest rates, the distribution of average forecast errors, the distribution I showed you before, is much more symmetric around 0. Okay? So in those periods, the consensus is actually not too bad. Okay? Now, the last thing to do, as I said, is to try to provide an explanation for this systematic bias. And usually, this evidence of predictability or state dependence in the forecast error is seen as evidence of irrational behavior, okay? Non-rational expectations. But there are a few potential rational explanations as well of these dynamics in the forecast errors. And there's a very interesting paper by Kwabion and Gorodnichenko. What they do is to try to derive testable implications for theoretical models of expectation formation. Okay? Some of these models are related to some kind of informational rigidities, like noise information or stick information. And the way to test these models is to run a regression of the forecast errors, the aggregate forecast errors. So this doesn't hold at an individual level. This has to be done for an aggregation on the forecast revision. So how the expectation for a specific period changed with respect to the previous quarter or the previous month. And if these informational rigidities hold, so if there is some noise information or stick information going on, then you should find positive relation between forecast errors and forecast revision. And this is what they find for CPI and GDP forecast. But running the same regressions, we find a negative relation between forecast errors and forecast revisions. So how do we explain this negative relation? Well, on one side, there doesn't seem to be an information rigidity, okay? But there are a few potential theoretical explanations with full information and rational expectation, which would imply this exact behavior or this exact relation between forecast revision and forecast error. And these are models in which we have heterogeneity in loss aversion or forecast smoothing for reputational consideration. So for example, you can think that agents do not want to change too much their expectation with respect to the previous period, okay? In such models, you would find this negative relation. Or again, if they are maybe more worried about negative mistakes than positive mistakes, again, you would find a similar behavior, and these are fully rational explanations. Now, obviously, it would be interesting to see exactly what is the true explanation, okay? Is this heterogeneity and loss aversion? Is this forecast moving? And there are alternatives as well. So Mango was talking previously about learning. So learning is another potential explanation. Well, they are forecasts. I'm talking about errors in excess returns, okay? So if you imagine that they are trading on these expectations, okay, so if they expect a large expectation, they, if you want to go along the bond.
Traders, that's why. So the objective function is in order to minimize the forecast error.
Yeah, exactly. So, yeah, I'm talking about loss, not loss in terms of predictive power, loss in terms of, trade. Okay.
Okay, so they're trading their own forecast.
In theory, yes. I mean, if you want to believe this forecast, you have to believe that they actually, trade on this forecast. So they try to affect the prices based on their expectation on the market.
Well, I don't know this context, but in the context of company earnings, the analysts who make forecasts for company earnings, I'm not so sure actually they are allowed to.
Well, these are financial
there's a lot of room for manipulation. I'm not so sure if they're actually
yeah, but in terms of analysts doing earnings forecasts is, I guess, completely different, because they will probably also have insider information in some cases about the company to try to come up with earnings.
It's the conflict of interest between if you give the information to the traders before you give it to the clients. But there's no reason why you shouldn't be able to trade your forecasts
about the interest rates. So
because you don't have that.
Yeah, these are financial institutions, so obviously they trade in the fixed income market. So yeah, I'm talking about loss aversion in the sense that if they expect a positive expected return, okay, and they trade, let's say, heavily on that, and then they realize excess returns is lower. So you mean if they make a lower or a negative error, okay, it's worse than just maybe expecting a little bit lower expected return, and then it turns out to be even better. That's not too much of a problem. Right? So yeah, this behavior, these dynamics of the forecast errors could be consistent with some of these explanations, and we still have to try to come up with additional testable implications of the different set of models to try to see exactly what is going on here. And maybe it's not just one explanation. Okay? Maybe there is a little bit of this, and maybe there is a little bit of irrationality as well. I mean, it's difficult to say. We really want to try to dig deeper here. Yeah.
So if it's I was thinking forecast moving for reputational considerations. You should, in that case, you should see jumps as people change. So you get new people coming in, replacing. So you Deutsche Bank, they have a forecast. They replace their chief economist.
Problem is that usually you'll see that the same institution is not in the panel for the whole time series, right? So they will be in the panel, let's say, for, 40 months, and then they will be out of the panel for a while, and then again in. And the analysts may change, but not, within the same sub-period, may change between one or the other. So then the jump is not necessarily related to the change in the analyst. It could be related to the state of the world or, the macroeconomy and so on. So, yeah.
Quite very similar curiosity. Do you observe people who check for survivor bias amongst the forecasters? Because you presume that those that are bad forecasters are less likely to stay in your sample, and the ones that are good
No.
to stay.
Yeah, this is
over time, but you should actually get better and better.
exactly, and this doesn't seem to be the case. No. So there is no survivorship bias.
Another quick observation about the potential explanations, but just with regards to systematic people, systematic optimists and systematic pessimists. What we're kind of lacking in this, but perhaps we should completely adopt a different area of sciences, is optimism and pessimism are also personality traits, and these tend to be pretty stable for genetic predispositions and other reasons. So it could well be that is yet another potential avenue.
Yeah, I also believe it is very rational, if you want. It's very normal that you can expect somebody to be particularly optimistic and somebody to be particularly pessimistic. Yeah, and that's, I mean, I like this result also because in theoretical general equilibrium models with disagreement. Well, I have another paper in this area, and I want to make sure that the dynamics I choose for the disagreement is consistent with this behavior, so that you cannot have, if you want, switches in the relative pessimism or optimism, but you have the optimistic guys staying optimistic and the pessimistic guys staying pessimistic, which makes a lot of sense. Okay, so this is basically it. There's a lot more to do. So as I said, it's very preliminary. In particular, these theoretical explanations, I think they're very interesting. And we want to try to come up with, consistent story why we have this particular empirical evidence. And, well, any comments is very welcome. Thank you very much.